Good morning and welcome to this Wednesday, April 1st edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is April 1st, but this is not April Fool's Day. We've got futures down again this morning. Last check, they were down about 750 points, but I'll give you a quick update on that because they are fluid and they've been moving pretty quickly this morning. Yeah, about 767 points is what I'm showing right now on the Dow. So we're looking at about 3.5% across our major indices at the open. And this is a reminder of what we experienced at the end of February and especially throughout the first few weeks of March. A lot of gap downs. Now, what followed those gap downs in the prior month were, well, what we saw was a lot of stabilization during the day. So almost all of the damage was done at the beginning of the trading day, and then we would hold our own throughout the trading day. It's going to be interesting to see if that holds true, if this is the start of another down leg, which I think it certainly could be based on some things we'll talk about. Let me go ahead and show you first what happened yesterday. And you can see here that the Dow Jones Industrial Average finished down just shy of 2%, down 410 points. S&P 500 down 1.6% or 42 points, back below 2,600. NASDAQ finished right at 7,700. That was down 74 points on a relative basis, dropped less than 1%, so a little bit better on a relative basis. Also, mid caps and small caps did better on a relative basis, especially small caps, which were relatively flat. But that relative outperformance has been rare for much of 2020 and really going back the last couple of years. Mid caps and especially small caps have been underperforming. So on the selling today, it will be interesting to see whether or not we get the pullback. One quick analysis looking across the major indices here is notice the Dow, S&P, and NASDAQ all went up to their 20-day moving average. Mid caps, small caps did not quite reach it. As far as industries go, sectors go, energy was the only winner yesterday, up 44 cents. The XLE finished back over 29. That was up about 1.5%. Outside of that, though, it was all red. Utilities, real estate, financials, and consumer staples all hit the hardest. And we did have utilities break above the 20-day only to lose it yesterday. And when you look across the sectors, same as our major indices, everything right now is trading below that 20-day moving average, which is below the 50-day moving average. All of our PPOs, daily PPOs, negative. Momentum is clearly to the downside. We had a bounce, and I'm going to show you in just a second how that compares to some of the other bounces that we've seen during very volatile, fearful periods in our history, or at least in my history, my trading history. And we'll get into that in just a minute. First, I did want to show you just on a 5-day, 10-minute chart, the S&P 500. We topped at about 11:30 yesterday. It looked like we were trying to make a recovery. You can see late in the day, on a few of these days, we've had some pretty nice action into the close, well, barring back on Friday of last week. But that was not to be yesterday. We actually fell off of that 2615 area, closing back down 2584. So we lost about 1.5% on the index in the last maybe hour and a half or so. And so that was not setting up well for today, in my opinion, closing down near the low of the day after failing to hit or to clear key moving averages like that 20-day moving average and also key Fibonacci level I'll talk about in just a second. Before I get into that, just wanted to point out 10-year Treasury yield. Don't like to see this down. I mentioned recently one of the signals I was looking for was to see whether or not the 10-year Treasury yield could hold 0.7%. Off of this rally, our first pullback here was 0.7%. We had another rally back to about 0.7%, a smaller rally back to 0.7%. Notice back on Monday, we went below, we closed below it, came back up, tested that level, and now we're moving back down again. The significance here is that when the 10-year Treasury yield is falling, it means money is rotating into Treasuries, which is defensive. So the market, when we're fearful, look for safety, and Treasuries are considered much safer. So this action right here is a signal to me that this is not going to, that this rally to the upside in in equities that we've seen over the past week or so, maybe a little over a week, is not going to last. At least that's my opinion. I believe the odds are greater that we're going to go back down, perhaps get a retest, maybe even move lower. We need to watch certain fear gauges. Keep an eye on that, because for me, as the fear ramps up, and it's already high. I mean, after all the buying that we saw in the market and things stabilizing, the volatility index never went below 50. 50 in any market would be considered crazy levels of fear. Yet we pulled back to 50 while the market rallied this past week and a half. That's normally not a good sign. I want to see that VIX initially begin to break below 40, 45, and we haven't seen that. We're probably going to see the VIX spiking again today. All right, so that's where we look right now. As far as economic reports, we did have the ADP employment report come out today. March ADP employment, the market was expecting jobs to drop by 180,000. They only dropped by 27,000. So it did go into negative territory. Bad news, but it was better than expected. We do have March PMI manufacturing coming out, I believe 9:45. And then March ISM manufacturing will be out at 10 a.m. this morning. Both are expected to drop. And in the case of the March ISM manufacturing, supposed to drop from 50.1 down to 44. And there are wide ranges on the estimates. Just like no one can really predict how this virus is going to continue to move over the next, few weeks to several weeks, maybe several months. The market has no idea really how the economy is going to respond to this. I mean, this truly is unlike anything we've seen before. So estimates are all over the place. Companies, we're going to have earnings coming out soon. Companies are withdrawing guidance left and right. They have no idea what to expect. Companies that are able to shift quicker to an online strategy or already do have an online strategy, I think obviously have a major advantage over other companies that don't have that luxury. So I think this earnings season is going to be unlike anything we have seen before. And I would say, and I'm an earnings guy, I'm a CPA, I was in public accounting for many years, audited companies. I'm technically driven, but I still keep one eye on earnings from a fundamental perspective. I like companies that can beat their earnings estimates, revenue estimates. Right now, I think the stock market could care less. I hate to say that, but the market doesn't care about what you just did in your last quarter. The market is only looking forward. And right now it's so cloudy and it's so uncertain. And that's what leads to impulsive selling. When the market can't figure something out, the first answer is sell. Figure it out later. And so we saw that February through about first 3 weeks of March, got a rebound, and now we've got some issues again. So let's take a look at some of these issues. S&P 500, here was your February 19th top. Here was your March 23rd low. A lot of my analysis on the market right now is analyzing what is happening in the stock market during this period, because Wall Street has now all of a sudden gotten this whole new set of data and data points that they have to try to figure out. They've got a lot of brilliant people on Wall Street. Economically, they've got their own healthcare experts that they turn to. They've got a lot more information to gather, really good information that you and I don't necessarily have access to. A lot of our news reports, I don't know how everybody else feels about the media, but I'm not a big media fan. If I'm looking for health news, I generally go to CDC or the World Health Organization, something like that. I'm not going to tune into CNN or one of these other news networks. I don't know whether I'm getting the actual facts. I want to go to the actual source to get my news. So I think part of the problem is that we've got, a lot of fear out there for good reason. And then we've also got a lot of fear because of media. Media is trying to get attention. I mean, they're trying to get people, they're competing against other networks. They need you. They want you to click, and they've got to figure out ways. They just can't say, things aren't looking very good. Well, that's not going to get a lot of clicks. But if you start putting death tolls or something like that in your headlines, that's how you're going to get people to click on your links and so forth. So just keep that in mind. I mean, again, I try to look for the news from sources that I can trust. So make sure you're doing that as well. But as we move down, my whole point here is that Wall Street is assessing everything that's taking place in real time and making real time decisions with their money. Obviously, the overall bias is to sell, but there are areas of the market that are holding up much better than other areas. And that's part of my job and all of our jobs, is to try and figure out what areas, where that money is shifting, so that we're better positioned when all this is said and done to ride out the next bull market. Now, you think back to 2009. I'm sure plenty of you have looked back before and said, wow, if I had just done this back in March of 2009, wow, things would have been so much better. Well, we've got another opportunity, because the market, when it's fearful, just throws everything out. The baby goes out with the kitchen sink. I mean, everything is tossed, but some get tossed a little more gently than others, and those are the areas we need to be focusing on. So here's your S&P 500 drop. Here's your rebound. This is the same chart I've been showing. I wrote over at Stock Charts about it, been writing to our members in our daily market report about it. The first Fibonacci level, 38.2%. The S&P literally went up to about 5-10 points of getting there yesterday. This shows 2650. And again, do I have it exactly at the top, exactly at the bottom? It's hard to say. But 2650 gives us a guide. Yesterday's high was 2641. Pretty darn close. The 50% Fibonacci level is 2793. Now, most of the time when you see all this fear, you get a rebound, and then you get a double bottom at a minimum. Usually we go down and retest, and we'll look at those charts in just a second. But here's the S&P 500. Now let's look at the NASDAQ. This is the NASDAQ 100. Here's your top, here's your bottom. And look at this. We went beyond 38.2% yesterday. I've showed that at 78.98. The high got up to 8,011 before we reversed and came back down. Notice we got up to this level close to 7,900 3 days ago. I mean, the market's tried to keep going higher, but really we've been churning here over the last couple of days. And with today's futures, it looks like we're ready to roll back over to the downside. Okay, now in an article I wrote back on March 24th, I said, and that was the day after we bottomed, really at 9 a.m., I said, history says to consider this resistance level as a potential bounce area. 1987 market crash. Here was the big drop, almost exactly very similar to the drop that we've seen in 2020. From top to bottom, we lost roughly about 1/3 of market cap, and maybe just a little bit more than that here. Well, we just lost 35% on the S&P 500, a little bit more than 1/3. Here was the initial drop. Now, we came back very quickly, but that initial bounce went right up to that 38.2 Fibonacci level, and then quickly right back down near the lows. And then you can see we established this trading range. Didn't ever take out that low, although on a closing basis, we did close a little bit below that prior closing low before we bottomed, and then the rest of the secular bull market played out. I think it's too early to make this call. I do think we're still in a secular bull market, just like we were in 1987. When this all hit right here in August of 1987, we were at an all-time high. Just like in February of 2020, we were at an all-time high. So this is not unprecedented in the sense that in a secular bull market, you can still have a very significant cyclical bear. And that's what I think we have right now. I really believe once we get past this, and I don't know when it is, I don't know if it's going to die out over the warmer summer months and we don't get it back, whether it dies out and it comes back later in the year, another cycle of this, or whether we just never, we just have to keep social distancing for a while. But I do believe in our medical community, we got a lot of brilliant people working on this, and they're studying the virus, they're working on vaccines. Once this is behind us, I think the market will explode back to the upside. I honestly do. But are we going to do it from the levels that we just saw on March 23rd at the bottom? Is that the bottom? Or do we have another leg or two down? That's the part I can't answer. And the reason why I don't trade a market, or at least I don't trade very much in a market when the VIX is up at these levels. It's crazy. But anyway, that was 1987. Look at 2008. Now, 2008 was a little bit different because when we saw the massive drop to the downside over a very short period of time, 1261 down to about 840. Once again, this is about a 33% drop in almost the exact same number of days that we did it in 2020. So this is another period I think that's worthwhile looking at. We bounced, and it was in 2 days, but we bounced up into that 38.2 to 50% Fibonacci retracement level before turning back down, putting in a double bottom, going all the way back up there again, and then we continued moving lower. Keep in mind, 2008 was part of a secular bear market that started in 2000. So from 2000 to 2012, we could not break to new highs. From that high 2000, we went down into that first bear market. 2007 went back to the 2000 high, couldn't get through it, went back down again, put in new lows. And it wasn't until March of 2009, this bottom right here, that we began to start moving higher. And it wasn't until 2013 before we actually took out those prior highs in 2000 and 2007. So the environment now, aside from all the fear and panic, which is very similar to 2008, the type of market we were in is actually more closely related to what we saw in 1987. Strong, advance, great economy, strengthening economy, and then we have, just the bottom fall out for a period of time. So right now we're trying to assess that bottom, trying to figure out that bottom. And then I went on to show the 2020, March 2020 move and where we could be looking. And this was back again, written on March 24th. So I put the arrow in here, 2649 at the time. We just hit 2641 yesterday. So here we are now looking a week later. You look at this chart and pull it up, and there's your rebound. So during this move to the upside, what I was focused on was, number one, areas that were outperforming. Also, one thing that has really been interesting throughout this is that when you look at the spider, and the spider gives you true opens, the S&P 500 does not. Some companies in the S&P 500 don't open right at 9:30. They might start trading at 9:30 in 15 seconds. And so at 9:30, the S&P looks like maybe it didn't go down very much, but if you look at the spider, you'll see huge gaps because this is pricing all the stocks as of 9:30. So anyway, if you look though, and you see it going down, you can see that that initial low back in the end of February on an accumulation distribution using that tool has not been violated, even though prices kept going down, spiraling lower. We never took out that low. And the reason for it is that, like I said earlier in the show, most of the move to the downside was represented by gaps. We were gapping lower. Everything was so fearful. Treasuries would spike at the open, and stocks would fall precipitously at the open. And then look at all these hollow candles. So a lot of what we were seeing was big gap downs and then reversals during the day. We didn't see a whole lot of big red candles until this one back on March 20th, Friday, March 20th. And then Monday, the 23rd, looks like we were falling apart. And then we came back and then we started our rally. One other interesting thing is the VIX was beginning to fall as prices kept going lower. Usually the VIX goes up as prices goes lower. So I think it was on March 23rd that I actually wrote in the DMR that one positive bullish sign was the fact that the volatility index was drifting lower, even though prices were falling and setting new lows. That's generally a pretty good sign because it's telling us fear, even though prices are moving lower, fear is starting to drop. And when that happens, normally we see a bottom. So, but temporary bottom, in my opinion. So let's see here. So let's talk a little bit about sentiment. Now, here's a chart of the equity-only put-call ratio. And what I have up the top here is a 5-day moving average. Now, when this ratio is moving up, it's telling us that there are more puts being played versus calls. Puts are more bearish if you're going in on the long side. You buy a put, you think something's going down. You buy a call, you think it's going up. So and most traders do trade these options on the long side. There's a lot of sophisticated ways to trade options. Not going to get into all that. But essentially, when you look at the overall long-term picture on the market, when you see this ratio spike, and I'm going to say the 5-day moving average, when it gets above 0.8, 0.85, if you look at these green dotted vertical lines, when we get up here, it coincides with some pretty significant lows in the market, these green dotted lines. When we hit 105, that marked the bottom. Now, we could have said, well, it's at 0.8, let's jump into the market. Obviously, that would have been a big mistake. I like to see these tops form. And in this case, this one formed at 105 and started rolling over, and that's when we got our bounce. But now we're back in the neutral territory. So now a lot of that fear that we saw a week and a half ago has kind of come out of the market a little bit, which I think sets the stage for another push to the downside. Something to watch. Another article that I had written a while back, this was back on February 27th, so just a little bit after the top, a week after the top. And I said, what a difference a week makes, searching for a bottom. This is where I started talking about the CPCE and how the low readings mark tops. All right. Now, as we started to move, now this was back on February 19th. So this chart right here was as of the market top. This is what it looked like. 1 week later, as I was writing this article, you can see now that the CPCE, equity only put call ratio, is rising. Prices are falling. So I just put out a question there. I was like, okay, are we going to get back up into this level? And if so, how much further are we going to fall? And I remember talking about this 3,025 area because that's where we had a lot of resistance where we finally broke through. And so when we lost 3,025, I was kind of hoping that's where we would hold on the selling. And we went right through it. I mean, if we go and, pull up a chart here, get the current chart, you can see we went down below, had one quick bounce, and then boom, to the downside. Really, when we get into fearful markets, the market could care less about our technical price support levels. I always say market makers go on vacation. Their job is to provide liquidity. When the market's fearful and everybody wants to sell at the same time, market makers don't have the capital to simply just let everybody get out. They're not going to take that hit. So what you see is they actually join in on the party and short. They can short just like we do. So all of a sudden, you've just got tremendous supply and very little demand. And this is what you see. The volatility goes up. And I wrote to members back on February 26th, I believe it was, right around this time of this article, 26th, 27th, I don't know, maybe 25th, but talked about the fact that the VIX had spiked above 20. And I don't like it. I don't like trading markets when the VIX is above 20, because once the volatility is high, you get these big moves up and down. And some traders like, yeah, you can make so much money. Well, the flip side is you can lose a lot of money if you're wrong. And capital preservation is very important to a trader. So for me, I tend to sit on the sidelines and just kind of pick my spots, look for themes, and make a little bit of money if I can. And I'm happy as can be if I can do that. That's my approach to a highly volatile market. I would much rather trade a boring market where the Dow goes up 22 points and the VIX is at 10 because I don't have to worry as much about my capital being at work. And I can fully invest. I can find some outperforming areas of the market. I can swing trade, hold stocks for a period of time, not really worried about that much about a big drop in the market. Can't do that right now. And that's a big change for everybody. One other thing I wanted to mention here is the VIX. So in this chart, I was looking at these different areas where maybe we could drop to. And I said, okay, if we get down to that 3,000 level, that would be pretty good because a lot of these bottoms connect at 3,000 with this one little head fake back at the end of 2018 with the trade war. And actually it was more Fed related, I think, in my opinion, but I won't get back into that at this point. But I was looking at that level. And then the other, if you keep the same slope of these highs and connect it to the 2009 low, I'm thinking, okay, maybe we could get to 2,400 if things really started to fall apart. And we click on this chart and you can see we went a little bit below that before we bounced to 2,600. If we go back down and take out that 2,200 level and the VIX is back up in the 70s and 80s, I think we could go down to 1,800. That's the lows that we saw back in 2014, 2015, 2016. And again, when the market's fearful, we've seen how fast it can go down. Now, I'm not calling that. I'm just saying I'm being very, very cautious in this market. I said yesterday in the daily market report that I said to be patient. If you wanted to short, let this rally play out. Let it get to at least that 38.2% fib level. We got there. I think that the odds are with the shorts at this point. I think the market, more likely than not, is going to go back down and retest those lows. All right. One thing I want to point out, though, and this is over the last month, and this doesn't go back to February 19th because this is only a 1-month history of the sectors. And of course, right now it's April 1st. So this is going to go back to about March 1st. But you can get a real sense throughout the month of March where the relative strength was. Healthcare, consumer staples, technology. I can tell you the majority of my trades right now are in these areas on the long side. And I've said before, I don't like to short. I will hedge occasionally, and I actually do have a very small hedge right now on the leveraged ETF that tracks the NASDAQ 100 on the short side, the QID. It's a very small position. And I do in my trading account have a couple of long positions, but they're mostly stocks that have been holding up during this move to the downside. I've got Zoom, ZM. I've got Regeneron Pharmaceutical, REGN. And I think there was one other, Clorox, CLX. Those are the only 3 stocks I own right now on the long side. And I've got the QID as a little bit of a hedge in my retirement. And that's it. I'm just kind of watching and evaluating. I do want to tell everybody later, I'm going to show you this. Let me get rid of some of these. I do want to show you that later today, this is where you go to Stock Charts TV. If you go into Stock Charts and you click on this Stock Charts TV link, it'll bring you in here and you can watch shows on here. I participated, we did a recording yesterday for this show, The Pitch, coming up at 12:30 today. So you can watch this. 15 stock ideas in uncertain times. So it was me, Mary Ellen McGonigal, and Grayson Rose, each giving 5 stocks. One of my stocks was Regeneron Pharmaceuticals. One was Zoom, because these are stocks that I believe are undergoing a thematic change. The market is undergoing a thematic change, a paradigm shift, if you will. More and more companies are going to be allowing people to work from home after all this is over, said and done. This is just more efficient. Parents that have kids at home, it makes sense. We've been slowly moving in this direction. I think the coronavirus is going to accelerate that movement. So I think working from home is going to be a big deal. Now, along those lines, and I'm going to give you a little heads up on one of the stocks that I mentioned. I just wrote about it this morning in our EarningsBeats Digest. I also wrote about it over at Trading Places in my blog this morning. Peloton. Now, there was a study done by, I think, a company called Performix. Yeah, Performix. It's one of the top-ranked online marketing companies, one of the largest online marketing companies. They have over 1,000 employees, and they're based out of Chicago, Illinois. But they went in and looked at search statistics in Australia over a 2-week period during this coronavirus to see what people were searching for. And of course, the number one theme was toilet paper. I have to admit, I probably added to that, not in Australia, but in the US. And also, side note, I actually found some yesterday. So that was a very exciting time in my life here in 2020. But one of the things that they talked about was this whole theme about working from home. And a couple of the search terms that were showing tremendous increase in people searching for, one was workout routines, and another one was home gyms. So, and their philosophy and their thought process through this is that they believe that intent, that when somebody searches for something, they have the intent of following through. I mean, if you're searching for a home gym, you've got a certain intent on maybe buying a home gym. Otherwise, why would you search for it? So their thinking is that intent is the best predictor of behavior. And by understanding what people are starting to look for in terms of searches, it's going to help us figure out how this world is going to evolve, how our world is going to evolve beyond coronavirus. I think Peloton is one of the companies that is seriously going to benefit. Number one, they already are in this business. They already have things set up where you can purchase a bike, you can be home, and they've got a touch screen where you're streaming live and on-demand classes. So just like that, you've got a gym in your home, a virtual gym with all these other people. You can compete against them. You can compete against yourself, blah, blah, blah. It's a great concept in this market environment. Now, when I looked at the chart, you can see it moving down to new lows, and you might think, wow, that's horrible. But as it was moving to new lows, look at the accumulation distribution. Look at the volume picking up. These heavy volume days were showing strength to the upside. We're going to go beyond 930, by the way. And I'll give you a market update here in just a couple minutes. But Peloton, on this move to the upside, right here, just exploded to new lows. So when I see a stock that's putting in lower price action and higher accumulation distribution in a market where we've seen rotation throughout the trading day, as I mentioned earlier, these are the types of stocks I want to gravitate to. One stat, and I mentioned this in the Trading Places blog, I said I would provide it here in this show. One stat that just blew me away on PTON, their short interest. Keep in mind, back in December, Tesla had short interest of about 20% of their float. And when they broke out, you saw what happened to their stock, went from 200 to 900. I'm not saying that Peloton's going to do that kind of a thing. Peloton's got 42 million shares in its float. As of March 13th, 23.4 million shares were short. That is 56% of their float is short. Now, that's as of a few weeks ago, so maybe that number's come down some. But those are just guaranteed buyers. So now not only do you have the short interest, which could lead to a major squeeze, but you've also got a company that kind of fits into this new theme that's going to emerge. Now, maybe other companies will come out with better products that we're going to have to watch, but I think Peloton is in the sweet spot. So this is one of those 5 stocks that I mentioned in the upcoming show, the pitch. And again, that comes, I'm going to show you here, that comes out today. It's going to be at 12:30. So if you remember, go into Stock Charts TV and just tune in. Dave Keller is hosting, and he does a great job hosting. And then I'll be joined by Mary Ellen and Grayson. And I tell you, all the stocks that Grayson and Mary Ellen mentioned, most of them I had on my initial list. When Dave told me I had to cut it to 5, I looked for 5 that they didn't pick. But I'll spill the beans here a little bit. They like Microsoft. They like Amazon. They like some of those. I like them too, but I pulled them off my list. I wanted to go with 5 that they didn't pick. So anyway, it's going to be I thought it was a great show that we recorded yesterday. And again, it airs today, 12:30. Make sure you check that out. May give you some great ideas. And I'll tell you, Grayson Rose, if you don't know him, he's very young, but he is incredibly knowledgeable and experienced for somebody his age. Very impressed, always been impressed with Grayson. And, he's got some great thoughts for people who have been experienced and in this market for a long time, but also for folks maybe that are new to the market. Made some great points about 2009 and take a look at a 100-year chart on the S&P 500 and realize that this too will pass and that we're going to eventually be into a much better market. So now's the time to do your homework to find those companies that are going to come out of this stronger than ever. And I believe the Amazons and the Microsofts will. And I think smaller companies like Peloton could, based on the way they're set up. But anyway, check that show out. All right, let's see. What else do we have here? Well, let's do the 3 and 3. Let me give you a quick market update first, and then I'll give you the 3 and 3. So right now, we've got the Dow Jones down almost 800 points, 3.5%. NASDAQ outperforming a little bit on a relative basis. Look at small and mid caps, all of a sudden underperforming again. Just not good action. I can probably, one of the things I'm going to be doing over the course of this next down leg, if it materializes, which I think it probably will, is I want to look to see if the same groups, if the same makeup of this next leg down is the makeup I saw from February 19th to March 23rd. This is the kind of stuff that I like to share with our members at EarningsBeats, because I think it's going to lay the groundwork for what we're going to be looking at over the balance of 2020 and beyond. I don't know if you recall, but any members in the room, when the Fed turned from being very hawkish to very dovish, I did a similar type study. Once they came out and they said, hey, we are fully behind this, I think it was back in like September of last year, the market took off and then it pulled back. And I was doing the same thing, looking at what happened. What was that initial Wall Street reaction when the Fed finally became more dovish? And then when it pulled back, okay, what was happening during the pullback? And that laid the groundwork for our fourth quarter last year and into the early part of this year, where I was extremely bullish because of what was going on underneath the surface. And so there's a lot of analysis that needs to take place here, and it's still that I'm still looking at and is still taking place. But those are some of the things I'm going to be thinking about. Not necessarily worried every single day what the market's doing. I'm looking for opportunities. I'm trying to drown out the noise, stay away from the media, and look for opportunities, because I think there are going to be a ton of them as we go forward. All right, let's do the 3 and 3, and then we'll wrap up the show here. And if you're unfamiliar, 3 and 3 are just 3 stocks that I think look really interesting under the circumstances of what's been taking place, especially. But I said earlier, I'm looking at accumulation distribution. Let me give you a few names of what I'm looking at. Here's Intuitive Surgical. And actually, let me put it on my relative chart, and then I'll change my RSI. Actually, I don't have the RSI on here. Let me add my accumulation distribution. Okay, and now let's update this. So this is a relative chart with the accumulation distribution. So here is ISRG. Now, if you look at this, a lot of big hollow candles, just a couple of red filled candles, not many. And that generally translates into strong accumulation distribution, which it does here. Now, this stock is down, but one of the things I'm doing is I'm looking at these stocks that have a history of trading down and then rebounding, like ISRG. Look at the stock. It was down earlier today to 453. Right now it's at 462. These are good opportunities, stocks that are showing accumulation distribution, to maybe look at some of the early morning weakness. You don't need to buy a lot of shares. Small positions. That way you're not going to lose much if you're wrong. But because it's so volatile, you can have small position and still make a good amount of money trading in an environment like this. But you can see ISRG actually bouncing after the initial open. Similar to what it's done over the course of the last 5 or 6 weeks. So ISRG, look at the relative strength. It's okay. This is versus the medical equipment group. It's not far from maybe about an 11-month high. It did break out relative to the S&P 500. That was an 11-month relative high. So this isn't a bad looking chart. Volume trend's pretty good on this rebound. Yeah, this is one that I could have on my list of possible trading candidates. Next up, Cigna. Same thing. See the accumulation distribution? Prices going lower, accumulation distribution rising. See these long tails to the downside? You know, when you close near the high and you are way down here intraday, that adds to the accumulation distribution because it shows that there was a lot of buying intraday. So Cigna trying to break out versus the healthcare providers, trying to break out versus the S&P 500, and strong on the accumulation distribution. This one gap down, opened at 169. It's up 13 cents since the open. But what I have found so far during this tumultuous period since February 19th is I don't want to hold overnight. That's where most everyone is getting killed. And I don't know if the next leg down is going to be like the last one, but I'm not taking any chances. Today, we did exactly what we were doing before, opening up, you know, looking at futures and seeing deep red. And that is not a good feeling if you're 100% invested in the market, or even worse yet, if you're in margin. I can't imagine trying to trade this market with margin. I wouldn't do it personally. I wouldn't fully invest, period. I mean, like I said, I think trading very small pieces is the way to go here. Last one I'm going to mention, this was another one of the 5 stocks that you'll see on the show later, Wingstop. Now, Wingstop's in the restaurant group. And you know what? One of the most surprising things I saw when I looked and did my analysis from February 19th to March 23rd, I mean, it's easy to say, okay, airlines are going to be a bad group. We knew that. You know, cruise lines, the recreational services area, that's going to be, you know, a really beaten down group. We knew energy was getting killed, you know, with crude oil prices dropping as a result, you know, as well. So we knew what some of the bad groups were going to be. When we started shutting down restaurants and bars around the country, I'm like, okay, here comes another group that's just going to be tossed out. You realize that from February 19th to March 23rd, out of the 104 industry groups, restaurants and bars were 44th. They actually outperformed more than half the groups. And I just kind of thought about that for a minute. I know they're still doing takeout. A lot of them are still doing takeout, even if they've closed. And so, and people are generous. People are trying to help support their local community. And I'm thinking the companies that increase their market share during this period are companies that are probably going to evolve as major players down the road. And so that led me to Wingstop. I'm also a big fan of Chipotle and have been for a long time. But I'm going to talk about Wingstop here because, and I'm going to stretch this out. This is a 1-year chart, but take a look at the last 5 years. When you look at Wingstop relative to the restaurant group for the last 5 years, look at how it has been absolutely dominating restaurants. Then when this all hit, well, this is actually the restaurant group. Here's the relative strength. I'm sorry. Here's Wingstop relative to the restaurants and bars. So when we got the big drop in the restaurant group here in February and March, Wingstop broke out to a new relative high. It is breaking out relative to its peers. So it's the market is telling us, you look at their chart and you say, wow, the stock got hit, it's bounced back, but it's still down quite a bit from where it was. You don't get the same sense of appreciation for what this company's done or doing based on, looking at the relative strength. And despite being in a group overall that has been very bad since August of last year, Wingstop relative to the S&P 500 is actually at about a 7-month high. So Wingstop looks good. Now, I did a little research, and Wingstop just recently announced that they're going to do 3 weeks of free delivery. Anybody who wants anything, they're free delivery. And what they're doing is they're building their market share and they're building loyalty among their customers. People are home. They want options to eat. You got a company out here that's, appealing to a lot of folks. The other thing that's pretty cool about Wingstop is I think they have 1,300 franchised restaurants, 1,200 and some are in the US. This is a company that hasn't even gone global yet. So here's a company, I think, and it's very basic. It's wings, it's chicken tenders. It's not any fancy menu, but it's quick. And obviously this is a company that's done very well over the last 5 years. And when I pull up the accumulation distribution, it's breaking the new highs. So you don't see, except at the very bottom here, a couple big red candles. But for the most part, if you get this stock early in the day when it's down, you tend to make money on it because that accumulation distribution is on the rise. Now, is today the day where it falls? I don't know. And it's very volatile. Here's a day right here where you can see the stock fell to 68 intraday from 75 the prior day. That might chase you out of the stock. And then by the end of the day, it was up over 80. So it's very volatile, but the good news is it is being accumulated based on the accumulation distribution. Anyway, I know I've spent a lot of time, went way over today. This is the longest show that we've ever done. I think it's important, though, to take a look at how this market's been operating. If you're not already a member at EarningsBeats, we'd love to have you come over. I try to share a lot of my knowledge, expertise, my analysis. This was my background before technical analysis, before I did all this, is I used to love to analyze. I love putting things on spreadsheets and figuring out something maybe that a lot of the market doesn't know. Maybe the smart money knows, but a lot of the rest of the market, when you just look at the numbers, you don't really get a sense of what's taking place. And that's where that analysis comes in. So we'd love to have you join us at EarningsBeats. There's a $7 trial for a month. And that $7 trial that $7 is refunded for a period of time. So if nothing else, I can hopefully help walk you through this market for the next 30 days. We would love to have you come on board. So you can simply just go on over to EarningsBeats.com and right here, just click on this join today. You'll learn a little bit about our service and then just sign up here. And again, $7, but you'll receive a refund in 5 to 10 business days. All right, that is it for today. Please, everybody, be safe out there in the market. Also be safe and listen to the social distancing guidelines. Stay home if you don't have to go out. Let's all get through this together as a community. And on the other side, on the flip side, we're going to have so many opportunities to take advantage of. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for Trading Places Live. Happy trading, everybody.